None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everybody. It's Friday. I'm not sure when this happened, but it did, in spite of all of us, I guess, right?
It feels like a shorter week for some odd reason. I don't know why.
Yeah, I wonder why. I don't know. It's today we're going to talk about global warming. No, I'm just joking. That's going to be our feature of the day. Anyway, just because it's going to be 104 here today, that's why. Anyway, the plan for today is, as usual, we're going to summarize the week. We're going to talk about, some of the factors that are starting to show up. It's actually been a pretty interesting week. Once we broke out of that pattern we were in for 13 weeks, wow, it feels like it never happened in a way, but I guess it did. I feel like now that we've broken out of it, we got every day's going up now, so it's right into this range that we'll go through the details that I've been talking about in commentary, the 1920 to 30 level. But fundamentally, some of the commentary I talked about, is bad news, good news. Everybody's tied into that the entire first quarter was all about snow. Now, we don't know anything about that in Scottsdale, so it seems kind of oblivious to me. I have no idea what that means.
We got our fair share of it up in Minnesota, I'll tell you that.
I'm sure all you folks back east, I know you got that. So, but it just doesn't set home with me. So I'm like, really? So maybe it's because of where I was, and we didn't even have a winter. We still had our sandals on in January. So, but the bottom line is there were effects that happened then, and it's all being shuffled off, and everything's going to be better. Meanwhile, we continue to see the same old, hot and cold spots in the economy. Not a lot, that you can point a finger to and say this is it. We're definitely going in a direction. Claims were down a little bit. I guess even a GDP of minus 1%. To think that snow can cause a minus 1% in the U.S. economy, that's pretty amazing.
It is.
But that's what it is. Maybe it's even worse. And did it recover? I mean, I've heard numbers of people throwing out 3% and 4% now. So who knows what it will be? Expectations are kind of all over the board, but it doesn't appear that anyone cares because the markets are acting as if it's already out anyway. So that's anticipating what's going to go on, and most likely when we do find out that was the case, maybe second quarter was better, then we will, I guess the market will have already anticipated it and priced that in. So then there'll have to be something else that's going on out there. So as usual, didn't really see anything that was earth-shocking overnight or anything that happened. It's pretty quiet out there. Just with the market sentiment changing and the cash flow going toward the buy side, pushing the market higher. There is a lot of talk about the low volume, which is perfect from my viewpoint. Most rallies, most sell-offs that are sustainable are on below average volume. I've talked about this before. It's really about the aggressiveness of the buyer or seller that moves the market, not how many of them there are. And I've certainly seen this in trading pits over the years. It's if you've got the right guys buying and selling, the prices are moving it, and they don't have to have a lot. The offers or the bids seem to get out of the way when they need to be. But it's one of those phenomena that happens when I mentioned. I think in commentary last night might have been the night before, they blur together to me, is that you get, when we do see a big volume day and the price is up big on that day, that's probably going to be the climactic end of this particular sequence. And I don't, on a minor level, that's going to be how this plays out. But you have to realize we went sideways for 13 weeks, so the next event, it's got a lot of stored energy in that 13 weeks for people that were maybe setting aside just in and out, that are maybe now willing to make a commitment even at 1920 on the S&P, which is pretty amazing if you think about it. 1920, and there seems to be plenty of buyers out there. No one seems to be fearful, and that's how the market works. So it's interesting going through this cycle of historical highs, because I guess it's difficult for a lot of people to comprehend what's going on here. We'll go through some of the details here. So we're going to go over, I'm going to move Mitchell off the screen. I'm going to go over to and start talking about some of the technicals here. Like I said, fundamentals aren't really driving the market. The technicals are. So let's go ahead and take a look at this. The chart I have up there right now, this is the weekly graph of the S&P 500. This is the cash, and you'll see that we are breaking out. I'm going to squeeze this down just a little bit so you see a little bit more. You can see this entire rally going all the way back to October of 12. This thing has been steady Eddie going up, and there's been a couple little scares, but for the most part, it's stair-stepping its way up. The lines that you see on the board, I'm going to point out a couple of things. These Fibonacci price projections that I use, and coming up with just drawing where these things have occurred. We now have three of them, which I've talked about, and in commentary, and primarily on the Monday commentary. But the objective of 1973, and then it's 2032 and 2070, and those are ranging between about a 4 to 8% range. I guess at 2000, I think we end up around 4% or so. So it's best case 8% on the upside, and on the other side maybe a minimum of 4. And when you're in rallies like this, folks, this thing can end at any second, but it's not likely to. And that's what I've been discussing over the last several weeks, actually, is that the bias continues to be the upside, and there seems to be a rotation going on, which is good from a standpoint of how the markets are operating. So if the same set of stocks are always driving the markets, then you end up with that's where the top ends. And even though we have fewer stocks, we've seen some rotation. Even the VPM database has increased about 4% or so, 4 to 5% in its bullish consensus from over the last, I say last 2 months. We've actually seen an increase from around the high 46 percentile range to about 50% now. So it's pushing about 4%. So it's not a lot, but there's a rotation occurring, and we continue to have a big holding in bonds and other elements. But these objectives that I have on the screens here have been being projected all along this rally, and primarily, I'm going to take off these arrows here, primarily the ones during this, each one of these levels have been met, and now we have one more new level coming off, and it's about to be met. I mean, we're 50 points from 1973, which is the minimum objective here, and typically, if you look at the minimum, we tend to go through the into the mid-range. So we're probably going to hit the range of 2032, or we call it, go from the bottom side, 1973 to 2032 is going to be the range of expectations for this market to go up into. Depending on, we'll go into some VPM stuff in a little bit, but depending on where you are right now, most of the strategies are probably still 60, maybe some of them increase to 70%. And that's fine when you're sitting here at these levels, because the market is, while it's rotating, it's also very selective. It's not a super broad range, and that's why the volume is out there that you're seeing is low on a relative basis, as well as what's going on with VPM is also reflecting that. It would have to go over, I think, 62 or 64% bullish to suggest that there's another cycle on the upside going on. But for now, there's certainly a rotation going on, and the three phases, like let's go from like 2009 when we had very heavy liquidation. You had heavy liquidation, lots of cash, very few stocks being owned in the database. I think we get down to 6 or 7% on the lows back in 2008 and 9 period. And then when you go from there, you get to the investment phase, which we saw go to where you see a very high percentage of these stocks being owned. And in fact, it was from the crisis, we went from 7% to 92% by the time we got into the fall of 09. And that was the historical high in the database from that. I've never seen it 92%. Normally it gets around, extremes are 72, 76 range, maybe in the close to 80, but it just doesn't get that many stocks, financial items all long at the same time. And so what we've seen since then is just a continued deterioration of the breadth, or maybe a normalization is a better way to put it. So it's really more normal of what we've seen in the past. So these objectives that have been projected all along this trend here, we got this big long trend that's been going on. It is continuing to demonstrate that we can stair step this market higher. So until something different happens, we're going to expect more of the same. If we go down a little bit here, and let's look at the daily. Let me just take the trading system off here for a second here. I found a very easy way to turn things on and off here. So that's nice. But you look at this, here's the range that we've been in. And I think as I mentioned when we were in this craziness, so I'm just drawing a flat line through here. When we were in these type of patterns tend to resolve themselves to the upside. I remember talking about that on one of the Market Thunder shows, and it sure did. And we're seeing, if you look at PPMs just on a short-term basis, the short-term is now at 0.26, so that's actually gotten into a trend mode. We're still not there on the other two, which are 0.09 and 0.03, which are basically flat. They're up slightly, but very slightly. So we're not seeing the acceleration yet. It will take possibly, if we can get up to this 1930 number, we can see that accelerate if it gets up there fast enough. If it kind of chugs up there and grinds to those levels, then we could see some momentum loss. But the other two levels, the PPM 2 and 3, should start to pick up as we go through there. And I normally don't go to this level, but I want to look at it, so and I'll do it with you folks, is looking at a really shorter version of this and looking at the 60-minute graph on the cash. And you'll see the same type of things that I was talking about. And I guess this is my world that I live in, and it's having these tools that I developed and having an understanding, and you folks embracing our technology. You're in the same mode from that standpoint. But these target ranges, this is on an hourly graph, and you can see the same scenario here. They're stair stepping up, and we now have some new targets coming in over here, which are giving us a 1926.40 to 1933.72. Those are the shorter term ranges off the intraday charts that are coming out that also target, I think the extreme here is 38.24 on the extreme off of this current pattern. So as long as we stay above these averages here, you're going to see the this thing continue to move toward these target zones. So 26 to 33, which is in line with the daily targets of 1920 to 1930. I think it's 1920.95 and 1930.95. So that is confirming what we're seeing on the longer term charts. In this case, the daily and the weekly graphs are confirming all this. So once again, talking about the top down, this is usually as far down as I go. You can actually go down and take a look at a 5-minute graph, and all of these same stair-stepping patterns that get generated off these patterns within a trend are consistent all the time. So we're seeing, we're looking at the I guess the insides of the minutia of the trends that are unfolding. And last but not least, we'll go to what I call the super slow-mo. We'll go over to the monthly graph, and not much changes here, but we are seeing the same thing that I've been talking about, which leads me to the conclusion that we are gradually here approaching a major high, and it's not here yet, and it looks like it's multiple months off. It's just, if this market went into a sideways range again for several months, then we would see this thing probably unfold. So let me show you what I'm talking about here. PPM1 on the monthly is 1.32, PPM2 1.5. That says that the 21-month moving average is moving slightly faster than the 10, and the 40-month is lagging, which is okay. But what usually happens, and I've talked about this before, when you get to this range, let me change this. I'm going to draw a circle around the 07 highs. When you get to this level, what happens is ultimately the 10-month and 21-month start to get narrower, and ultimately, once this pattern goes sideways, like what we saw in 2007 at the highs, then you see this consolidation, and it starts to turn down, and then you get some sort of decline here. And the same thing, I've drawn this out before, but the same thing continues to happen. Same story. I know we have some common folks that I guess folks that are on every show that are watching, and we have some new folks that haven't heard this. But this pattern is the final leg of this market, I believe. And there's an argument here that what we would see next, matter of fact, I am going to take this off and enable so I can drag the background a little bit, and I want to move this chart over so I can draw a little bit of expectation off this top level, because I think when I'm looking at this stuff, I'm seeing it happening. But like I said, this is a super slow motion, which is good because it's sort of like the Matrix, right? You can see the bullet, so you can kind of just dodge it just in the moment in time to be missed. So that's what we're seeing here as this chart is unfolding. So these two averages right now, you can see a little better, are spread out pretty good. This is still the spread mode that I talked about when you're in that robust trend. But it is starting to show where this 10 period is going to go out. So what would happen? There's an argument, and we're going to talk real long term here for a minute, that this pattern here, I don't have a text tool handy, so I'm just going to put arrows and talk about this. But this would be 1. This down here would be 2, and then the argument is that this is 3, but I'm going to present an alternative argument here, that the next event would be a sideways event that I've drawn in already. There'd be some kind of wedge set up here, and then there'd be another high down the road. And this is certainly within theory, within expectations, but it just this little zigzag that I've put up here, and it's actually what it's called, it would represent about to get down to a normal corrective phase would represent about a 12 to 14% decline. And that would be within the context of this. And also, just to draw this pattern, these are monthly bars. We're talking about a year, maybe 14 months of a somewhat defensive market, not necessarily, I'm just drew an arrow down that the giant collapse and into the world. Maybe Dr. Doom and some of the folks out there that are talking about it's going to be worse this time than last time. Not sure why, but I'm not interested in going there because that's to grab headlines and to get your publicist is guiding that guy, not maybe his best well thoughts. And it's always nice to predict the big crash or the big rally because then you can always say you said so. In my case, what I'm trying to do is guide us through what's going on in the markets that makes sense from what our perspective of managing money from a wealth standpoint. And none of those things matter anyway, even if they do happen, because guess what? We will be selling and be protecting like we did in actually all the way back to 1998 and then 2000 and then 07, 08 and all that. It's going to be the same thing. You get lucky once, sometimes you get lucky twice, but probably not 3 or 4 times. There's the way that this process works, and that's what I hope to achieve also by doing this show, is to show you the consistency which how these numbers and how this theory that I've spent my life developing evolves and how it works. So I'm hoping that a lot of folks finally can see what some of the stuff in. I won't call it genius in it, but I will call it a lot of hard work, an awful lot of hard work, and paying attention for 30 some odd years. Most people don't have that attention span. I'm pretty sure if my mother would have had Redland, she'd have stuffed it full of me when I was a kid. So I was not an easy child to raise. But anyway, this stuff is what makes the consistency, and this is why when we talk about process over attitude and opinion, is process gives you the constant perspective of at least where you think you are. So you're making the right types of decisions when you're doing that versus operating in fear. I talked to an advisor the other day that said, "Gee, I've kept my clients out of the markets because I'm fearful of the deficit and all the craziness out there." And in the process, I haven't protected them at all. I missed out on a major opportunity, and that happens a lot. We've seen that with you can overthink everything, and the beauty of trend following and what we're doing is the ability to not have those things guide what you're doing. In 2000 and we'll call it 10 through most of 12, it was a very erratic market with a lot of risk around. Once this thing got traction, we've been on this thing big time, as it should have been. That's where the next leg really started. In between then, whatever the marks were on 12/31 were just what they were based on a volatility. There weren't really trends going on during those years. There were really choppy, trendless markets. And once we got to a trend market again, here we are. And but I think that this perspective is good. I want you to notice one thing: on a long-term basis, there are no long-term new objectives being generated on this chart that we're looking at here. And to me, that is really telling us that from a long-term standpoint, there's a lot there. We have to depend on the intermediate objectives and the shorter-term objectives to guide us to this final high. So I have just went on and on, but I was having fun anyway. So let's do a real quick review. Let's talk about our friends over in the Treasury market, because there's plenty going on there again. So bringing up the 10-year, look at this, 2.46. Economy's better. The stock market's going up. So once again, who's right? Are the bond players right? Why are yields dropping? Are they playing the right 1% of the when the GDP declines 1%? Are they playing the weaker economy? Is that what's going on? Why is all this cash flow going into treasuries? And VPM continues to own bonds, and I was looking at some bond strategies up 7 and 8% this year. Pretty good stuff. Beating the heck out of stocks. Some, I don't know who's got it right. It really maybe at the end we'll be able to say, the stock market had it right, the economy was better, or I'm not sure what's driving this money. I've tried to look through and figure it out. I have failed, but we are pushing down to those lower levels that I talked about, that 245 level. We're basically there. Below this level, not much more below this level, we are talking gloves off. This market could continue to go down to 2.25. And if that's the case, I don't know, maybe there is a weaker economy. Maybe we all wake up one day and find out that the end of the markets are there and we're declining and all that. So what was it? I think one of the Fed chairman, one of the Fed presidents of one of the districts came out and said something about, they're going to be pushing yields up by year end. And that's very possible. Certainly the Treasury market doesn't care. So let's, and by the way, that this is off the lows here real quick, and then we'll move on and start to go through some of the stocks of the day. And I probably will talk about, since I update the Japanese yen, which is still on my mind and still in my account. So it's keeping my attention by that. But if you look here, the low was 2.40, so we were down below that 245 level, and we're up a little bit today. But one thing I do want to mention real quick here, just before we bolt off of this is important as well, is we have, look at the PPMs on the interest rate on the 10-year, minus 1.07, telling you that the trend is more than a trend. Minus 0.25 would be a trend. We're 4 times that, and 0.93 on the 21 or the PPM2, and then 0.32. All 3 of these are in downtrend mode. So I guess the only other thing that we could look at, I actually haven't addressed this, so I'm just never going to get done here, Mitch. I can see him off screen. He's wondering when I'm going to get done. I just can't get done today.
You're fine. Go for it.
I've walked myself into a place where I can't get away from. But let's take a look at one thing here, because I think this will be interesting from a standpoint of, I want to see what from the highs here to the lows, what our downward target is likely to be. And this is interesting because the 248 level would be, like I said, not much below this level where we are right now. It's a black hole, or a big drop between there. The next target range would be somewhere between 232 and 218, with the possibilities of going down to 2%. Doesn't sound like a stronger economy. It doesn't sound like the Fed's, I'm not sure what's going on there, but it's definitely, that trend is very likely, especially with these PPMs like they are. This is a weekly, this stuff doesn't dissipate very quickly. We could start to bottom here, and then in the case of maybe 4 to 6 weeks, if we stabilized here, we could see some of this downward momentum bleed off. But for right now, own bonds like VPM's telling you to own them, and be fearless, because that trend is real and there. And it's odd, like, maybe this is how it's supposed to work. That with all the money flow has changed over the last several years, and I used to say way back in the 80s, our job was a cash flow analysis. So if money was coming out of bonds, where was it going? And if it was going to stocks, where was it going there? That was our job to figure out. We've got money flowing in both places right now. So there's so much money. The markets have expanded so much over the years in magnitude and size, and the way that capital gets distributed and the amount of capital that's out there has been really interesting, especially since the crisis. We've been in the age of building even more debt. It's just different type of debt, whether it's sovereign debt or corporate debt, whatever you have. It's huge what's going on out there. But meanwhile, the appetite for this stuff is never ending, it appears, anyway. All right, I'm finally done. I'm going to bring Mitch back on, and we're going to talk about a couple things here with the stock of the day. So it looks like I'm bigger than him on this screen. So it's really hard getting this stuff symmetrically right. Anyway, I guess I am ready, Mitch, when you are.
All right. How about BIG, Big Lots? They came out with updated estimates today, so I thought it'd be good to highlight them.
I did see that.
And the optimized trade system on that is weekly 1.2.
All right. So now I've got it set up so I can just go in here and enable strategies and do it just like that. And there we go. So make it full screen. Yeah, so interesting pattern, actually. This pattern, I love this segment. This is becoming one of my favorites, because what it does is it highlights all the different ways that VPM gets in and out of the market and how it handles these patterns. And for me, it's just it's very revealing, and I think for those of you that are watching this show on a regular basis, you're going to learn an awful lot on how the system thinks and what it does. But here's a classic here where we've got. Let me go over to. We're getting rid of Mitch and I both, so we can do some pure technical stuff. This pattern is really pretty interesting from the standpoint that it just came out of this major sell-off here. I can have it. So we got out of this trade. We bought it. Look, the idea was that I'm going to take off two of these arrows real quick here. Put them all back on. So we bought the trade here. The expectation by VPM was for it to go up here, and you can even see there was some Fibonacci expectations that were built into that trade when it occurred. The stock going up to around 47 or so from 30, 37. I'm going to look at the exact numbers here. But what you see here is the market failed, and it made it one bar 1 week. It failed. We got out that next Monday. It was over. Market went up a little bit, then went down and troughed out, and then started a little to gain, and then all of a sudden, I'm not sure what the events that happened around, if those were news events or what happened around this particular stock. I suspect there was some kind of news where all of a sudden it shot up, and we got a new buy signal here back around the same prices where it had fallen from. And so, we did actually pay up to get back in from where we sold out of. From my viewpoint, that's okay. Let me just clear up some of these arrows here.
But isn't that the worst thing that could possibly happen, is that you buy a stock at a higher price than you sold it? Isn't that just absolutely terrible?
No, Mitch, he's being bad. He's just trying to get me going on this thing. But no, so what happened was VPM, it's a good point though, because what happened here is VPM got out of a trade that failed, and it did continue down. But then something changed in the fundamentals, something changed in the perception and the sentiment toward the stock in the community that's trading the stock. So all of a sudden, I'm drawing an arrow through here. You're down to, if you did the mid range of that, it was a consolidation range. It broke down, and now it's popped back up. And look at, I'm drawing some arrows. Matter of fact, I'm going to clean this up because, but I want you to look at the PPMs down below. What happened when all this stuff started to turn? We saw the PPMs turn very quickly, and then I could tell you that it didn't have to go up that big to get that buy that day. It was right on the edge of buying anyway. Just so happened that the stock went from 28 to, it looks like, 34 in 1 week, and off it. Then it set up this pattern, got a little swoop. It appears, and now that I look at the stock, and this is something else you can look at by looking back at these stocks and their characteristics. I'm going to point something out I just recognized, but now we get the big move today. So I don't think it had done much. We can look at a daily chart here in a second. Let's do that. I don't think there had been much going on with this stock before. I think it was all about today. It was. So you can see this stock was drifting down, and I've got the daily chart. So actually we bought it and sold it. Did pretty nice, capturing most of that move off the lows. But yeah, this is good. This is a fun chart. I'm glad you came up with this name because look at what's happening here. This is from a technician standpoint. This is a classic mode. This stock likes to gap up and gap down. And just with this small sampling that I'm looking at here, we could go back further, but it is absolutely, this is how it trades. And so nice thing is, fortunately, from that standpoint, I clicked the wrong button, and I really clicked the wrong button. Hang on 1 second here. My haste to recover from my error, I made it worse. Isn't that typical? So from here, we had sold out right before this thing dropped, and then we bought it back off of this trough after some structure came in, and you start to see the PPMs and start to see some things come in, and the probabilities started to point to higher prices. Then we get the gap, sideways, momentum dropping. This is just on a short-term trend, and then it's been drifting. But when we go back over to the weekly graph here, you're going to see that the weekly shows you that this is that trough where we were just looking at on the dailies, and the gap and everything was where the weekly bought right after the gap that we were looking at on the short-term stuff. So this bar was the trigger point, and now we've got another trigger point where we have, when you look at it, we have two gaps in a row, and there's this is Edwards and McGee stuff. If you folks want to be technicians, don't read that book. It was written in the 30s. I thought everything's wrong, but there's a couple things you're always going to get from everything, and I had to go through years and years of understanding what was going on in the market to find out all the things that were wrong. It's a standard, so if you get a CMT, they make all the CMTs study that book, which basically sets them into being bad technicians. People ask me if I'm a CMT, and I said I would rather have a root canal. I don't know what I would rather be part of to have that happen. I'm not interested in that. They do a lot of things that are pretty, like most things. They try to make it like some standard that a technician has, and I've never been interested in that particular thing. But one of the things that there is, when you see gaps in a direction, so in the daily graph we were looking at a minute ago, we saw a gap up, and then it went sideways, it drifted lower, and now we have another gap, which is today. From a weekly standpoint, we bought that first gap, which is where I have the first arrow here, where my cursor is, and then the second gap was the part that accelerates the trade. And now, when you start to look at the weekly PPMs, all of a sudden 107, 141, and plus 71. This tells me, and I'll show you one more thing here, is look at the Fibonacci objectives of this pattern. There's two that's showing on the screen. I can't read the one. I've changed the scale to the top. I'll get to that. But $55 is a target on this stock. That is like another 25-30% on this stock. So this, if you own this thing, enjoy. It should be a fun ride, and it's not likely to fail because all of the momentum has been set to really accelerate on the upside. All right, enough about big. Let's go on.
All right, how about eBay? And that's also on the weekly 1.2 system.
That was the same model, right?
Yes, sir.
Okay. Yeah, so we're out of this one.
Yep.
And yeah, so this is kind of the I'm not sure what to say about this. You got. I need to protect my computer. Sorry, I'm getting a flash up on my my McAfee but this pattern is pretty. I guess I don't know. It's almost like what happened in the stock market in the indices, but but when you look at this, we draw a straight line through the middle of this. We broke out and then failed, and now we've moved back down toward this level. It looked like it was doing better earlier today. Was there some news out on this, Mitch?
No, this is just the commonly held position.
Oh, okay. So there's a lot of folks doing that.
Yep.
I'm disappointed. I was trying to buy a new watch lately, and I couldn't find it on eBay. I can't find it anywhere. So I'm on a wild goose chase for a watch I want that no one seems to have. It's fairly rare. Anyway, the bottom line is, here's what's going on with the trend. Minus 0.26, minus 0.27, and the 40 is flat, which is okay because we just recently went under it. But you see a 1.26, that means this moving average is dropping 1.26% per week. That tells me, let's see, we'll look at what those values are here real quick so we can get an understanding of that. Not that it matters, because if you're following the system, you should be out of it anyway, but the downward trend here is fairly substantial, and let me get to the right numbers here. We've got, so we have the fast average, which is the 10, 53.48. Then we have the 54 and 53. So around $54, about where it got up to today, is where the major resistance is. And you've got these PPMs down. If you were a day trader, it would have been really good to sell off of these points in time. One of the things I used to do when I was on a Pacific Options Exchange was I would have numbers on stocks like this. If I knew these numbers existed, I knew where my buy-sell points were every day. And we didn't have devices back then, so I had to remember those numbers and have them on a little cheat sheet, maybe on a piece of paper. So let's, not much there really. Longer term, maybe take a quick snapshot at the long term there and take a look at that. eBay monthly, that's kind of interesting. 40-week moving average here, bring up the values. 40-week moving average is 44.35. So that, let me move this out of the way. That has a upward slope of 1.3%. So that's going to be a pretty good buy. You should see a bounce off of that level. Some of the other, it's going to take a while for this thing to consolidate, but just real quick on the ultra long term. Here, this is also a classic pattern, and it also plays into something I've talked about before. This is going to be, I'm just going to draw out the lines here, and I'm going to do my best to make sense of this. So what I've drawn here I'm putting a down arrow over one of the tops right now. That is actually where the one, this is probably one, and then this would be, I'll do a little arrow A, B, C, but then this is going to be 2. This is 3, and what we're seeing right now is most likely, I'm going to draw a circle around it. This is a wave 4 pattern, and which ultimately should move higher. We still have some objectives, but out of this pattern will be a really good Fibonacci level to be generated out of this. If this indeed would happen, we could see a nice pop to the upside on this stock. And I'm thinking about some of the things that we're looking at. Maybe one time, Mitchell, we should bring up and do a show on all the a lot of these benchmark stocks and that are out there, because there's a story being told on some of the stocks that are out there. That when we're looking at these, I'm getting a sense that there's a lot of stocks that are in this consolidation. They have some downside potential. It appears to be limited when you get out to the longer term charts. So that tells me that whatever possible correction we have coming is probably going to be somewhat limited. But we need to validate that, and maybe one of the shows next week will focus on just we'll do a more brief section from maybe Wednesday's session next week. We'll do a brief session on the indices, but we'll spend time going through these and trying to draw to a conclusion of what's happening from the standpoint of these major stocks that are likely to drive the indices. So maybe we take a hard look at maybe the S&P 500. There's 50 stocks that are driving about 40% of the index, about 32 or 34%. And we should take a look at those and just see what, in the big world, that's what's going to drive these indices. That's what's going to drive them down. And if we see a lot of scary patterns that they're topping and their major tops coming on those stocks, that'll tell us a lot internally about where we are in this market, maybe confirming some sort of high. But my sense at the moment anyway is that we're not at a major high, that we're seeing a lot of these patterns that are starting to consolidate. There's some downside, in this case maybe 10-15% on the stock, but which could ultimately set the tone for a minor correction and then more higher prices down the road. So.
All right, got that jotted down. So I'll add that to the list of research projects.
So just know, if we don't say it next week, it's Mitch's fault. So
yeah, thank you on that one.
I'm not going to take any responsibility. I'm going to put him back on screen so you can see that grin. He knows I've caught him before. No, I'm just kidding. But yeah, so we're trying to keep all this stuff together. So let's do one more quick one, and then we'll go back and summarize and kind of set up the tone for as we come in next week.
Let's do one more one. It's been on my list for a while. It should be a pretty straightforward one. SanDisk Corp. So that's a SNDK. And that one we are currently long that position on the 3.2 model.
All right, let me flop that. Now what's interesting about what I just did is both models are on there at the moment. There we go. So, yeah, this is a screamer, huh?
It is. I think we're up 100 and some % on it.
Yeah, and so this is good. I am on a monthly, so let me get over to a weekly graph so we can get a better view there. Yeah, you can see this trend, and we did a show last week. Do you remember which one, Mitch? We should remember when we did the 1, 2, 3, 2. We should actually label that on the website so that people know that we discussed that. We went through the 1, 2, 3, 2 syndrome, but this is a classic here once again of looking at how this thing works from the standpoint of 1, 2, 3, 2. The primary line that is going to drive this market for right now, from a modeling standpoint, is that 40 period moving average. And every time we came down to it once mid-cycle in last year. So we've been long this thing for the better part of a year and a half as well. Didn't didn't look at the duration. Can you look at that, Mitch, and see what the current duration is?
Yeah, bear with me 1 second while I get that.
No problem. And so what we're looking at this pattern, it's similar, but now we're getting the parabolic curve, and it's interesting because the short term, even though it's breaking out through the highs, it's starting to show some loss of momentum, but it's still going faster than the 21. So we talked about this happens on any chart, whether it's a 5-minute chart, an hourly, a monthly, doesn't matter, whatever spectrum you're looking at. But these PPMs will start to contract and right now they're still expanding, 198, 171, 139. So they're still expanding within this trend. So this trend is likely to continue. We've exceeded, I'll draw a couple more arrows, we've exceeded the Fibonacci expectations, which is also typical when you get into this acceleration phase in the markets. And when that happens, all gloves are off right now on this stock, and it's moving up. So, if we were to be walking through the last big Netflix trade while it went on, we would have seen these accelerations and these patterns unfolding, and you get these surges. And now this is a huge surge in price. It went from 72 to 96. It looks like about 8 weeks maybe.
Yeah, and we are past the duration on it. We were anticipating 329 days. We're now 346 into the trade.
Is that the what about?
That's a 3.2.
Yeah, but is that what's the extreme, the longest? Do you see that on there?
The longest we've held it is 459 days. Okay, so we're still a ways away from the longest.
Yeah, and there's some stocks. I remember. I don't know who's got the record. Mitch might actually have the stats to figure this out. The longest trade ever held once upon a time was Amgen, and it was like 3.5 years, and it was appropriate. It was a 3-2 trade. 3-2 is going to stay with these big trends like this one for a while, and I'm not sure what's going on. I had a discussion. I don't remember when it was, but there was a time when I thought that all the people are doing any kind of flash drives, because everybody's doing solid state drives now. And the spinners are quickly dying. And not only are they, I was talking, I have some custom built computers. And if you want a really good computer, I do an advertisement, go to digitaltigers.com. These guys are crazy good. They built Steve Ballmer's machine. They have their machines at Apple stores, Apple and Microsoft stores just for that reason. So
nice catch.
Yeah, exactly. Probably because I'm on a Mac, it was some kind of control in my mind right now. But I thought that these hard drives would be in big play, and the folks that were playing into that flash memory and all that is just continuing. There's been some pretty substantial improvements in that in the last year, actually, on the flash drives, both in speed and capacity capability. So, like everything, they're getting smaller, faster, and more capacity.
That's right.
So it keeps going on. That's the way the tech world works. But yeah, so this stock here, amazing trend. Nothing you can say, but if you got it, I wouldn't be afraid of it. A lot of times we've talked to you about in Process Warriors, when you're looking and you're doing a quarterly review, most of you should have or are about to done your quarterly reviews for your portfolios on the individual stocks. You want to be careful about just tossing stuff up because it's up 100 and some percent. There's something to be said for letting these things play out. Some of these companies get into a sweet spot of their growth. They get a big spurt in growth, and they can go on. I don't know. Can you click on something and get capitalization there? You're in VPM 2.0.
Yeah, give me a moment.
Just go to the quotes that screen where the quotes are to give you cap. But yeah, so I don't know how big this thing's getting, but these guys are doing a good job, and there's other players in this space, but it's been a good shot. I know. I think Micron was a good play last year. There was a couple in the tech sector along the lines of both processor and hard drives have been a pretty good play. So maybe this is played out. So if you own it, I don't think I'd buy the stock today, but I certainly, if I owned it, I'd go to sleep on this one for a while. Let it run.
SanDisk is currently at right around 21 billion. So
yeah. So that's nothing. Not in this world anymore, right? So we have a few minutes. So let's go back to, and I'm going to get it's just me on here for a sec here, and. One of the things I haven't looked at, it's interesting, so while we were talking, the market's backed up a little bit. And you can see this is the classic 5-minute chart that I talked about. This thing's been drifting. Look at this cycle came in right here, right before the drop. So these intraday cycles, this is a futures chart and a 24-hour chart at that. And we saw just a few hours ago, right, pretty much at the high, the hourly cycle came in, and now you see the swing index is starting to be negative, and we saw what I call a volume distribution type mode. So these levels here, by the way, let me just get the whiteboard out, and so I got 3 minutes, so I got to do this really quick. But these cycles here that you see that I'm drawing a line to now, all these cycles, these are what I call volume distribution. So you see a high spike in volume relative to what's been going on, percent change, and then you see typically a change in the markets, especially if they're marked out with like here was a big distribution here over to the left, and if you notice a big spike in the swing index to an extreme, and that was the low of this particular pattern. So whenever you see these distributions, there tends to be accelerations in prices when these things happen. And so this is like I said, a futures 24-hour chart, and then you can get down to minutia that I have up here now, where you're watching every tick and everything that's going on. But market's down 191. I mentioned in commentary, just in closing, that anything over 12.95, 1912.95 is going to be positive. Set a really good tone for us moving into next week. So Mitch, maybe we should promote a little bit of Process Warriors. What do we got going next week? I'm trying to quickly get out of my market mode and into that.
Sure. Yeah, for next week we're going to be talking about ETF and mutual fund strategies. So we're going to talk about what are the components that go into building the quality index-based strategy, like a mutual fund or an ETF type portfolio.
Okay. Yeah, and then, like I said, I just think we're excited about this. We're pretty close. Probably in the next couple of weeks, we're going to start bringing in some guests to come in on Process Warriors, that we can talk about some other elements we think that are important from a process and tracking, and we're going to get it going from there. And unless you have some final things here to go, we're down about the last 20 seconds here, Mitch. So
I got nothing else to add this time. Sorry.
Yeah, Mitch gets to drive back tomorrow, right?
That's right. I'll be crossing the Mackinac again tomorrow.
Yeah, fun. Yeah. So anyway, folks, have a great weekend. Next week we got a full week of work. I actually been noted to hate holidays because I like my job. I like what we do. It just disrupts the flow of life for me. There's certain holidays that I don't hate, but most of the ones like we just had are not that I hate it. I just hate being off work and disrupting my flow, because I'm an animal of habit. So that's the way that goes. But anyway, folks, thanks again. Have a great weekend, and we shall talk to you next week.